The Magic Kingdom is facing incredibly dark days in 2024, with steep stock market losses, lower subscription rates, film flops, and declining park attendance. Disney has entered a financial black hole. While operating costs continue to rise, the entertainment behemoth is struggling to restore profitability. CEO Bob Iger is warning about a slowdown on the company's biggest segments, and CFO Hugh Johnston expects financial performance to further deteriorate in the coming months. The House of Mouse is in the middle of an alarming crisis, and today we're going to share with you 15 signs that things are going from bad to worse to catastrophic for Disney right now. Without further ado, let's check out this list. 1. Most Americans can no longer afford to go to Disneyland. Visiting Disney theme parks is becoming a luxury only rich Americans can now afford. Prices have risen steadily over the past couple of years, and paid services like Lightning Lane system are making the cost of a trip to Disney even higher. The company has also reduced perks to hotel stays and hiked merchandise and food costs since 2022. A new study conducted by Wolf Research found that 70% of U.S. middle-class families can no longer take their kids to Disneyland. In 2024, the average cost of a 5-night Disney World vacation for a family of 4 comes out around $5,000. And that does not include the cost of food, merchandise, Lightning Lane, and airfares. The firm also found that Disney single-park ticket prices have soared by 56%, nearly 10 times faster than wages in America. 2. Still, prices continue to rise. Just a few months ago, Disney announced a new wave of price increases for its theme parks. Most single-day tickets under Disney's tier system, which ranges from 0 to 6, faced price increases of 6.5%. For example, a Tier 3 ticket is now $164, up from $154. Similarly, a 2-day ticket will cost $330 instead of the previous $310. Prices for the different annual pass categories jump between 6.1% and 20%. The Lightning Lane Pass, which allows guests to skip long lines, rose by 7%. On top of that, the Imagine Magic Key Pass increased $100 from $499 to $599. Other Magic Key passes increased by either $100 or $125 depending on the type of pass. The paid skip-the-line service called Lightning Lane Multipass increased more than 6% per person per day in California for people buying it in advance. It's safe to say that those increases will only push more customers away. 3. Food prices at Disney parks are reaching insane levels. Prices of food favorites at Disney World have risen even more this year, according to a recent report by financial advice website Finance Buzz. Since 2021, food costs have gone up by 61% at Disney parks, compared to a 32% increase in inflation over that time. In 2024, the price for Asana's bread service, which includes 5 breads and 9 different dips and sauces, has jumped from $9.99 to $22. Can you believe that? That means the cost has more than doubled. Another popular treat that doubled in price is the corn dog nuggets from Casey's Corner in Magic Kingdom, which have gone from $4.99 to $10.79. Some other famous snacks, including Mickey Mouse-shaped ice cream bars, have gone up by 63%. The famous Dole Whip rose by 58%. Churros increased by 54%, as well as the fish and chips meal at the Rose and Crown dining room in Epcot. 4. Almost 50% of families vacationing at Disney go into debt due to unexpected costs. A new survey from LendingTree found that about 46% of families with kids who go to Walt Disney World go into debt. That's a 33% increase from 2022, with only 18% of survey respondents acquired such debt. On average, parents of young children took on $1,983 in Disney-related debt. About 65% said the debt came from unplanned food-related expenses. 48% said it came from rising accommodation costs. 5. No wonder park attendance has been plummeting. Although Disney parks are far from looking like ghost towns, they are becoming increasingly empty, and that is leaving the company in a very tough spot, considering that this segment makes up for a large portion of its profits. CFO Hugh Johnston blamed the 12% decline in park visits witnessed throughout the year on changing consumer patterns and a challenging macroeconomic environment. He noted that higher-income consumers are traveling internationally much more. They have been opting to vacation in other places instead of visiting domestic theme parks. Industry experts argue that Disney prices have gotten so high that traveling to Europe and Asia seems like a much cheaper and attractive choice for many Americans. Meanwhile, the entertainment giant continues to pile up debts and report poor financial performance. 6. It's actually cheaper to visit Disneyland in Paris, France, than to visit domestic parks. A new report by KGPE, a local California news outlet, claims that Disney's astronomical price hikes have made it more expensive to visit Disneyland in California than it is to travel to Paris and go to Disney in Marne de Vallée in France. It cost a total of $4,571.50 for two people to stay at the Paradise Pier Hotel in July 2024, the cheapest Disneyland resort available, for 6 nights with 5 days of park tickets included. Comparatively, at Disneyland Paris, the cheapest on-property hotel, the Hotel Santa Fe, was quoted at only $2,173.66 for 7 days of theme park tickets and a 6-night stay without meals or insurance. The outlet said that even with a $1,456 flight from Los Angeles to Paris included, the experience would still come out to a grand total of $3,676.06. That amounts to a cost saving of $895.44 by going to Disneyland in Paris instead of California. 7. Disney has been posting alarming profit losses since the beginning of the year. During the first half of the year, the Walt Disney Company reported a combined 5% decline in profits, resulting in the loss of $2.2 billion. In the first quarter, operating profit went down by 2%, followed by a 3% decline in quarter 2. Executives cited that fewer folks have been vacationing in Florida and that dwindling foot traffic exceeded their previous expectations, along with higher spending and costs. While lower-income consumers are feeling stressed, upper-income Americans are more cautious about spending their money, the company's CEO stressed during a conference call with analysts. Consequently, investors have been dumping Disney stock at a staggering pace. 8. Many of its franchises have seemingly reached a dead end. Over the past few years, Disney CEO Bob Iger spent heavy buying franchises, including Marvel and Star Wars, that are now perceived as being tired and overworked. The Marvels had the lowest opening weekend of any Marvel superhero movie, falling short of even lowered expectations. Disney has in fact lost nearly $350 million on 2 Marvel movies. Before the box office flop of The Marvels, the low box office performance of Guardians of the Galaxy sparked a discussion of superhero fatigue, where audiences are becoming less interested in big-budget films, experts say. Meanwhile, its returns from Star Wars movies have failed to cover the cost of buying Lucasfilm, leaving the company with a multi-million-dollar profit shortfall. 9. Over the past 12 months, the entertainment titan has faced multiple box office bombs. In the past year, many big-budget Disney films like Strange World and Amsterdam bombed in theaters. Even though Disney released fewer films than usual, most titles fizzled. Wish, a recent release despite having good songs and good animation, feels like a prequel to all other Disney stories, with those Easter eggs popping up throughout the film. Moreover, the company suffered an estimated $296.4 million loss at the box office on its latest superhero movies, according to analysis of recently released financial statements. They reveal that the cost of making Ant-Man and the Wasp: Quantumania came to a staggering $762.4 million before Disney banked $124.9 million in government incentives, bringing its net spending on the movies down to $637.5 million. The production bombed at the box office, generating only $341.1 million. 10. So far, its streaming business has been a money pit. During the pandemic, Disney invested big on expanding its streaming business, but things rapidly changed when lockdowns were lifted and viewers no longer seemed interested in keeping up with the company's latest productions. Prices looked way too high compared to other streaming companies. Since it's been launched, Disney Plus has been operating at a massive loss. According to Forbes, the entertainment giant lost more than $11 billion due to low subscription rates and expenses far outpacing revenue for several consecutive quarters. In fact, Disney Plus reached profitability for the first time ever during the third quarter, when it notched $47 million in operating income. However, in the previous quarter, it faced a negative income of $512 million year over year. In other words, the segment is still far from generating any positive impact on the company's finances. 11. At the same time, operating costs are going through the roof. Recent numbers reported by the company show that in the first half of 2024, operating costs have risen far above operating income. This means Disney is spending more to operate its business, but it is not generating enough money to offset those high costs. From January through June, operational costs have climbed by 15%, while the company's income went down by 6.7%. Executives attributed the imbalance to inflation, higher labor costs, and lower than expected box office returns. 12. That's probably why its stock has been falling for 6 months in a row. Data shared by Nasdaq reveals that Disney shares are trading lower for the 6th consecutive month. The stock has now fallen 28% since the end of March, a rough comparison to the generally buoyant market in that time. The company's shares are the cheapest that they've been since 2020. It's now trading for less than 18 times what it's expected to earn in the fiscal year that ends this month. After sharing its forecast for the next quarter, Disney's stock closed down 3.6% in a single day at $81.94 and was one of the worst performers in the blue-chip Dow Jones. 13. To save on costs, Disney is shuttering several attractions right now. Fresh reports expose that multiple areas of the Walt Disney World Resort are set to shut down in the coming months as the corporation attempts to cut costs to restore its financial health. The closures include its iconic rock and roller coaster Strange Aerosmith at Disney's Hollywood Studios, as well as the 33-year-old Muppet Vision 3D, the Big Thunder Mountain Railroad, the Lightning McQueen's Racing Academy, and other big changes to Animal Kingdom, including the shutdown of the Dino-Rama area that features attractions like Triceratops Spin and Fossil Fun games, which are scheduled to close on January the 13th, 2025. 14. The corporation has been laying off thousands of employees too. Last month, the Walt Disney Corporation initiated a fresh round of layoffs, with corporate employees emerging as the latest victims of the entertainment giant's ongoing $7.5 billion cost-cutting effort. A couple of weeks ago, Disney said it was in the process of eliminating around 300 jobs, according to Deadline. In a statement provided to The Times, the House of Mouse said it's looking to manage its resources more effectively. The most recent wave of cuts is reportedly expected to span a number of Disney's departments, including legal, human resources, finance, and communications. This comes after the company cut 7,000 positions to reduce costs earlier this year. Additionally, Disney-owned animation studio Pixar reduced its staff by 14% because the famed unit was experiencing a box office slump. The job cuts also extended to Disney Entertainment Television, which lost 2% of its workforce. And 15. The outlook for the rest of the year is bleak. According to the Walt Disney Company's latest earnings report, investors should brace for another quarter of weak results. The report revealed that operating income declined by 3%, which represents a decrease of more than $900 million compared to the previous quarter. Executives expect a slowdown to impact the company and its theme parks during the final months of 2024. They forecasted a double-digit decline for quarter 4. Senior Executive Vice President and CFO Hugh Johnston pointed out that both Disneyland and Walt Disney World resorts are expected to see drops in overall attendance, citing recent economic uncertainty as a reason for a so-called demand moderation. At our Experiences segment, we expect that the demand moderation we saw in our domestic businesses in quarter 3 could impact the next few quarters. While we're actively monitoring attendance and guest spending and aggressively managing our cost base, we expect quarter 4 Experiences segment operating income to decline, reflecting these underlying dynamics, he said. This is what a struggling company looks like. Sadly, this seems to be just the beginning of Disney's downfall. With so many things impacting its bottom line, the Magic Kingdom needs a real-life solution for its growing problems. What are your thoughts on this? We look forward to reading your comments, and thank you for subscribing and for sharing this video with friends and family. Thank you for watching.